This athlete has a $1 million portfolio that's averaged 8.6% per year. And this athlete has a $10 million portfolio that's averaged 7% per year. That 1.6% difference costs our $10 million athlete $42 million over a 30-year investment career. But you see, it wasn't one particular investment that they made differently. It was the overall strategy. And this is what I see over and over again with athletes. As your portfolio grows from 1 million to 5 million to 10 million, the portfolio strategy, the investments that you choose never change. And this is the problem. In today's video, I'm going to walk you through exactly how I build portfolios from 1 million to 5 million to $10 million to make sure that you are not leaving any money on the table. The goal with any investment portfolio is to earn the absolute highest rate of return without ever running out of money. But to do that, you have to understand these three core concepts. Number one, what are you spending on a yearly basis, and what could you pull off your investment portfolio without touching that initial principal or interest? Now, this includes everything that you spend, even those one-time expenses. So you need to know that number. Number two, of that spending, how many years of that spending do you have in risk-off or safe investments? We call these war chest investments. So let me give you an example. Let's say you're spending $100,000 to be you, and you have $300,000 in your quote-unquote safe investments. That means you have 3 years of living expenses that could cover you if your risk-on investments went down. And number three, how aggressively is your portfolio positioned? Ultimately, this is going to dictate a vast majority of your return. But in order to understand how aggressive you actually can be, you have to be able to answer those first two questions. Now that we're clear on how important understanding what you're spending is to actually be able to build out an investment portfolio and achieve the highest rate of return, let's talk about how we build these out in the first place. What you're looking at here is a 3-bucket approach. And the way that I want you to think about it is there's thousands of different things that you can invest in. But at the end of the day, they all fall into one of these 3 buckets. Bucket 1 is that war chest bucket. These are going to be your safe investments. These are going to be things that are going to protect it from big market downturns, but they're also not going to earn a huge rate of return. Bucket 2 is going to be your core growth strategy. Think about this like public market investments, some real estate investments. We know that over long periods in time, this bucket is going to earn you a higher rate of return than bucket 1, but you're also going to see some fluctuations. And depending on how much money you're spending and depending on how much money you have invested, we have to be careful about how much money we have in this bucket. And then bucket 3 is that aspirational bucket, where we're going to take on additional risk, private equity, venture capital, things that are really fun to invest in, things that could give you a higher expected rate of return. But we also know that we're going to have illiquidity in this bucket. And we have to be careful about how we position the money in these 3 buckets. Now, in this video, I'm talking about building portfolios for professional athletes with millions of dollars. But whether you're a professional athlete or you're just starting out on your money journey, I have something for you. Our Moment Money Quiz is a free tool that in less than 2 minutes, it will cover 6 areas of your financial life and help you figure out what you need to prioritize to get smarter with your money. Let's consider our $1 million athlete example. At $1 million, our athlete is not in a situation where he's never going to have to go back to work again. So we know that he's not going to be able to just pull off the investment portfolio. That said, we still want to position the money aggressively enough that he's going to be able to capture all the upside that he has in the future. So the way that we have this portfolio position is our athlete spending $100,000 per year. And we have $300,000 in our war chest investments, 3 years worth of spending. And then we had the rest of the money, $700,000, positioned into our growth strategy. Now you'll notice a couple things here. Number one, we don't have any money in our aspirational bucket. And the reason for this being is we need to be able to have access to this money. Could earn you a higher rate of return in the future. It's also not liquid today. And we don't want to be in a situation where we can't access that money. But you can see our $1 million portfolio here over the last 20 years has averaged 8.6% per year. This is an incredible outcome, particularly for an athlete that might need to access this money in the future. But you see, here's the problem that he faces. Let's say that he had $5 million in the future. What I see time and time again is this exact mistake. All of a sudden, he goes and he has $5 million invested. And his investment advisor recommends that he gets more conservative with this money. And you can see here, let's say that he's spending $175,000 per year. But instead of having 30% or $300,000 in bucket 1, now he actually has a higher percentage in bucket 1. And it's a huge dollar amount, $2 million. Because time and time again, I see what happens with athletes is as we have more money, people tell us to get less aggressive with our money. But what if I told you we have to go back to what I talked about at the beginning, those 3 core concepts. If we want to earn the highest rate of return without running out of money, We need to understand what we're spending to determine how much we need to even have in our war chest bucket. So this athlete all of a sudden has more money, but he's earning a lower rate of return. In fact, previously he was earning 8.6% on average over 20 years. Now he's only earning 7.8%, but he actually could be taking on more risk. You can see at the bottom here, we have that he could spend $175,000 from his portfolio without touching the initial principal and interest. And here's a core concept that I need you to understand. How much money should you have in your war chest? Well, it all goes back to how many years of spending do we want to have there? And what we typically recommend is somewhere between 3 and 5 years worth of your spending should be in that war chest bucket. Now, how do we actually get to that math? Well, if you take a look at this chart, what you can see is that over some of the biggest market downturns, the tech bubble, the Great Recession, how long did it take from the market to go from market peak down to the very, very bottom and then get all the way back up again? And you can see typically it's less than 5 years. In fact, depending on how you're allocated, it could be as short as 2 or 3 years. And what we want to make sure that we do is we never have money positioned in our risk on assets, buckets 2 and buckets 3, that growth strategy and the aspirational strategy, that we're going to have to be able to use. But in fact, if you had enough money positioned in that war chest bucket to be able to withstand any of these market downturns, then you could actually position some of this money more aggressively. So what if we took a little bit different approach here? Now consider, if we just had 5 years worth of spending in our war chest bucket, what would that be? What $175,000 in spending, that would be $875,000 in our war chest. And then what if we said, okay, we can be a little bit more aggressive with some of the rest of this money. And we started to position roughly 10% of our money in our aspirational bucket. And then we said, we're going to position the absolute last bit of this money in our growth strategy. Now, all of a sudden, our return goes from where it was all the way up to 9.85%. Now, if you extrapolate out the difference of this over a 30-year investment time horizon, you're talking about the difference between tens of millions of dollars. And this is a massive issue I see, because all of a sudden we went from having $1 million portfolio to a $5 million portfolio. We took on less risk when we didn't actually need to, because we didn't understand the math and the dynamics between how much risk we could actually take. Now, this isn't just a problem between 1 million and 5 million. In fact, it only gets worse as you continue to go up the ladder. On a $10 million portfolio, this is what I'm going to typically see. A client's going to come in and they're going to have roughly $5 million in their war chest, $5 million in their growth strategy, and they're going to have absolutely nothing in their aspirational strategy. And the reasoning behind it's going to be kind of simple. The advisor is going to say, well, we don't have to take on any more risk. And in one sense, he's not wrong. But what you can see down here at the bottom is that you have roughly $350,000 you could pull off this investment portfolio without touching the initial principal and interest. But what if we said, okay, let's do our math together. If we took that $350,000 and we multiplied it by 5 years worth of spending, how aggressive could we be? That would position us with $1.75 million in our war chest bucket. If we took 20% of it and we put it in our aspirational strategy, which is a very reasonable amount at this level of net worth, we'd have $2 million there. And then we would be able to take the rest of our money and be able to position it in our growth strategy. And what that would give us is all of a sudden, our rate of return rises dramatically up to 10.10%. Now, let me put this in terms of dollars for you. Now, if you extrapolate that out over a 30-year time period on a $10 million portfolio, we go from a 7% rate of return to a 10.10% rate of return. The difference is more than $100 million. And again, this wasn't because of one hot stock tip. No, this was because of the strategy overall. We had to understand what our spending was. Then we had to understand how many years of that spending should we actually have in our war chest. Then we had to understand how much risk could we actually take above and beyond that to make sure that when we have our next market downturn, and I said when, not if, we make sure that our portfolios are positioned in a way that we can still earn the highest rate of return, but never risk running out of money. In fact, when I look at athletes' portfolios, time and time again, I see the same issue come up. The strategy that you had at 1 million is not the strategy you should have at 5 million, yet it's the same strategy. The strategy that you have at 5 million shouldn't be the strategy you have at $10 million plus, yet I see athletes come in time and time again, and that's the case. And the reality is they're leaving millions of dollars on the table by doing this. So if you're an athlete out there that's saying, I don't know if I need to have a second look at my portfolio, that's exactly what we do. At Moen Private Wealth, our goal is to make sure that you maximize every single dollar that you earn on the field. And we want to make sure that your portfolio is positioned in a way for you to be able to earn the absolute highest rate of return in the future. So if you want to check out our team, you can visit moandprivatewealth.com. We work specifically with professional athletes. And again, my goal with this channel is really simple. I want to make sure that you get smarter with your money. Until next time, my friends.